So today on the show, we're going to talk about being new to raising capital, going out to the market, trying to get people to invest. Maybe you have a track record, done a couple deals, maybe you don't. But here's the things I would stress when you're going out to the market, talking to new investors. Most of the time, the people are going to be wealthy. Obviously, there's all the criteria that's involved. But if they have enough money to invest, they're going to have done a business, or they have a really good job. They have some sense of money. I think the biggest thing to stress is the security of the asset. So opposed to something like stocks or other investments, apartments are really an inflation hedge. If you hold them long term, they're almost always going to outpace inflation. And a lot of wealthy people just want their money not to lose money. They don't like volatility. That's something that apartment buildings, for the most part, offer. Price can go up and down, but as long as you're collecting rents and not selling, you're going to get a pretty steady return opposed to a lot of other things. Things like flipping or buying one house, it's very dependent on the market. It fluctuates up and down, and if you have an exit, like if you're doing a flip and you have to sell it at a certain time, there's a lot of risk involved that isn't there with long-term property hold. The other thing I always like to talk to people about is when you take debt on an apartment building, you're taking a dollar at today's value, buying the asset that's, let's say it's $1 million building, and you're paying the bank back with dollars that are depreciating over time. Even at 2% inflation in 10 years, you're paying the bank back with an 80-cent dollar instead of a dollar that was worth the full amount 10 years ago. So that's a big upside. As long as the building's going up with inflation, over time, they always outpace inflation. The building's actually going up and you're paying the debt off with a dollar that's going down. So there's a nice spread there. There's really no risk. It's just allowing the government to print money, inflation to happen. We've had years like the last couple where inflation's really high, and that's been huge for anyone who owns property because you're now paying the bank back in the last couple of years with a dollar that's worth 20 or 30% less than it was. Now you just run that over the term of the loan. Usually we take 10-year debt. That's a huge upside, and the buildings have went up with inflation or probably past it. Scale is also another one where when you're buying a single asset, let's say it's a flip, it's risky. Like anything can happen. The debt market can change so quickly. An actual area of the city can change. Little things in the news can come out and affect interest rates, people's appetite to buy. If people think rates are going to come down, they might not buy today. And that can all affect that asset. If you're buying long-term, holding over a 10-year period, a lot of that risk goes away. It's also a lot safer when you have multiple units. If one tenant moves out in a house, you're paying 100% of the expenses and the mortgage. If you own a 10-unit building, that's only 10%. It's not a huge deal. If you own a 100-unit building, it really doesn't affect the investment almost at all. So scale is a huge benefit. Most people who have money will understand that. And then I also think you're really selling someone on time, right? There's going to be a difference in them going and buying the property, managing it, dealing with the tenants, and that's the hardest part of the investment. The buying, it's actually easy. Most people could go do that on their own. Most people who have money sitting around don't actually have the time to go and manage the property. So you're saying, hey, I'm going to do all the heavy lifting. I'm going to do all the work. I like it if you're putting money into the deal, and the investors coming in and they get rid of all the headache and they get the return. I think in something like what I offer in the fund, you're probably going to get a bigger return investing in the fund anyways, because we're buying better properties in better locations with more scale. I think those always outperform the smaller properties. Like, hey, maybe you could buy 8 units on your own, but we could buy 80 together. Here's the upside. Here's the multiple that we can get. There's tons of upside. Most wealthy people they just want to see the security of it. So depending how you structure the deal, like the way we have it, as soon as you invest, you're a beneficial owner of that property. So even if things went bad in year 10, the bank would take back their money and whatever's left goes back to the investor. So the risk to go to zero in real estate investing after it's past the first couple of years goes down drastically because you've already got return out, the properties went up, the mortgage has been paid down. So the actual risk to zero is way less than investing in a stock. The company could go bankrupt and you'd be at zero tomorrow. Doesn't have that volatility, and that is what a lot of investors are looking for. It's easy, low risk, low volatility. Again, depending how you structure the deal, but most of the time, like in our fund, for example, any investor that comes in, they're not actually signing on any of the debt. So for really wealthy people, if they've built up a bunch of assets on their own, they don't like the risk of having to put their name on the loan. So this way you're able to still own part of the property without having your name on the title. And that's a big benefit to people because the risk, if you put $100,000 in to buy $1 million property and you're signing on the whole million, there's a lot of risk there. If you only risk losing the 100,000 and somebody else is taking the risk on the $900,000 loan, that's a lot easier if you actually had the million to lose, that's a lot better option for most people. So in today's episode, we covered different strategies you can use, different things you can bring up when you're new to the market, going out, trying to attract capital, raise capital from sophisticated people or people who already have the money to invest. These are just a couple points that I would lean on, I would bring up for sure. Thanks for listening. We'll see you guys next week.